Hello everyone, Tim Hart is my name. I'm a Director of Private Mortgages Australia, and thank you for taking the time to watch this webinar. And it's all about fast funding in time for Christmas. So I want to talk to you a little bit more about private lending, where Private Mortgages Australia is heading as we head into 2019, and also tell you a little bit more about our processes and how we can do transactions very, very quickly. And that's really at the heart of private lending, is all about that speed and flexibility. So just to start off with, I just want to show those that are new to Private Mortgages Australia is the two products that we offer. Now, there's been some changes just recently in the last couple of weeks that we've made to our products. So the very first one, we do first mortgage lending, and we now have rates from 9% per annum. Previously, we were at 12% per annum was the minimum that we'll do. Also, we can now do loans up to $10 million, whereas previously our cap was $2 million. So it means we can just service a lot larger number of transactions, but it also means we can get a lot more competitive and cheaper pricing in there as well. The other product that we have is second mortgage funding, something that no bank will do in Australia, just because it does hold a little bit higher level of risk, because you're obviously sitting second place to a first mortgagee. So interest rates for that are a little bit more expensive. You're looking at 15% plus. Same again, that used to be 18% plus for us, but we've managed to bring that down to 15, and we can do amounts up to $2 million for those second mortgages. So we're seeing increasingly in the marketplace, and I expect this to continue right through 2019, and this is a lot around the Royal Commission and the tightening that APRA has been doing with investor lending. Also, we're seeing a huge constraint on serviceability and people looking at what the actual household debt of someone is, as opposed to just some modelling. And the other big one we're seeing a lot of as well that's really affecting the market is these interest-only loans, and when they start to convert to principal and interest loans. Coupling this with the banks just really do not like development finance at the moment. We usually see this in the cycle, especially when the housing market starts to come off a bit. Usually the thing that sort of hurts the quickest is those development sites, mainly because the banks stop lending on them. And ultimately what we're seeing is the banks lending less, therefore there's less money, less liquidity in the marketplace, means that house prices will come back. And all this is sort of led a lot of people who would traditionally go and get bank funding and now looking more towards private lending. So we've seen a huge uptake in the amount of people that are inquiring to us for private lending and our products, which is really good. And this has allowed us to start getting some more bigger backing from that institutional space that allows us to do these cheaper loans and bigger ticket price as well. So very, very exciting time at Private Mortgages Australia. We're really looking forward to 2019 and being able to help a lot more clients. And a lot of it, look, it is in that urgent funding sort of space, and a lot of it as well is around development funding. So the next thing I just wanted to cover off before we go through a case study example of an urgent loan we did last year, where we managed to actually settle a loan in 4 days, is tell you about the loan to value ratios that we look at, because it's probably one of the bigger questions we get asked is, look, how much will you actually lend my client? So we break every single postcode in Australia into 4 different categories. These are based off the Genworth financial postcode categories. And so category 1 is most properties are category 1. That's anything that's sort of within 40, 50 Ks of a major city. Category 2 is your bigger towns, but still have quite high populations. Category 3 is your smaller towns, and Category 4 is affectionately known in the office as whoop whoop, property that's in the middle of nowhere. And you can see that as the property gets further out, we lend less and less, like most banks do. You'll find traditional lenders, a lot of them don't look at Category 3 and 4, whereas we will entertain it. Most people only sort of focus on that Category 1 and 2. The last thing I want to touch on here is you'll notice there's a column called maximum, because private lending is all about flexibility, okay, and not having sort of hard and fast rules on some things. So as much as we say for Category 1 residential, we'll only do up to 75%, we do actually have discretion to go up to 80%. Now, part of that is is the transaction. It doesn't make commercial sense to go up to that limit. But we also look at the sort of the actual suburb that we're taking security over, and having a look at the supply and demand characteristics. Do we feel that suburb is going to be increasing in value over the next 6 to 12 months? That way we can see, yes, we're going to get a bit of growth. That means we can be a little bit more aggressive on that loan to value ratio. So just something to keep in mind. Now, the next thing I want to talk about is the sort of our process. And the reason I'm showing this is when we talk about urgent deals and being able to settle very quickly, it's very, very important for us to have a very streamlined, quick and efficient process from literally the person coming in the door to actually settling and then getting funds in their bank account, or a property deal settled for them as quickly as possible. So the way that we do it, and this is what enables us to do the process so quickly, is we make it very quick and easy for someone to submit an application. So either a client can either submit an application form, or we also have a 2-page quick app form. Okay, so it's the real high-level detail of the transaction, and what we can do with that is allows us to do our initial assessment and provide an indicative letter of offer back to the client. And a lot of time this is done within 24 hours, or in the example we did it even same day that we had the inquiry come in. And it's at that stage we get the client to pay the small assessment fee, which is usually between $550 and $770 to cover the cost of us doing all the title searches that we do in due diligence, credit checks, those sort of things. Once the due diligence is finalised, we issue the formal letter of offer, and once that's been accepted, we very quickly then can move to settlement. So let's look at an example, and this is a deal we did literally last year, so nearly a year ago now, and it was an urgent finance deal that came through. It was a developer who had a site that they were looking to settle on. They had a settlement date of the 23rd of December, and they came to us on the 19th of December. So that we literally met the client and they put their application on the 19th of December, and they needed to settle 4 days later. They'd been let down heavily by the banks with endless promises, and they just couldn't do it in the end. And they knew that if they couldn't settle on the 23rd, then realistically, the banks pretty much go on holiday between now and the end of Jan, that nothing was probably going to happen until sort of February. So they didn't want to lose the deal. They didn't want to lose their deposit. So they came in, they put their application on the 19th. That same day, we got back to them with an indicative letter of offer, and that client accepted that offer in the same day. We completed our due diligence the following day, and on the 20th, we issued our formal letter of offer, which was also accepted by the client on the same day. We then went to, got docs and all that sort of stuff organised, and managed to settle the loan on the 23rd. So those that have been in the mortgage industry before can appreciate there's a lot of work that goes into taking a loan from start to finish, including documentation and all the rest of it. It's a very, very quick deal, and especially for that time of year, the lead up for Christmas for us is definitely the busiest, probably 2 weeks of the year. But we love it. Look, we're very much geared up to do this, and we've brought on extra staff to cope with the demand. So these are the sort of deals that we can do. So this particular one, the valuation, or the actual purchase price of the property they were settling was $535,000, and we did a first mortgage of 75% LVR in it. The interest rate was 17.4%, and it was a 6-month term. The other thing I wanted to cover off as well is it's all well and good to talk about interest rates, but it's not the complete picture. When you're looking at private finance in particular, but I mean really any type of loan, whether it be from a bank or non-bank, is we try and educate our referrers and definitely our borrowers to look at the total cost of the loan, and that includes any establishment fee, or what we call an approval fee, because it's better to look at that total cost, because that allows you really to be able to compare apples with apples and see if it's worth doing this transaction or not. So we have an approval fee, and it varies depending on the size of the loan. Obviously, the bigger the loan, the percentage goes down accordingly. But what you'll notice here is that, let's say it was a $600,000 loan, that would have a 3% approval fee. Included within that 3% is a 1% referral fee that we pay to our referrers. So the idea of this is for us to be what we call channel agnostic. It doesn't matter if your client comes to us directly or they go through you, they're still going to be charged the same amount. So there's no financial benefit for them to come direct, and so they're more likely to stay with you as your client and go through you. As I said before, we do charge an assessment fee of $550 to $770. This is only after the client has seen the indicative letter of offer and is happy with the interest rate, fees and charges and all that sort of thing. And as I said before, that is really just to cover our costs of doing the due diligence on the file. Any other costs that are associated with the file, like legal fees, valuation, if there's a quantity surveyor that's needed, it's all done at cost. It's all done on a flow-through basis. The other way that we work with referrers, because referrers really are the lifeblood of Private Mortgages Australia. We probably get 95% of our business through referrers. So it's very important for us that we look after referrers. So in addition to getting a share of the approval fee, we allow our referrers to actually add in a referrer service fee that we can add into our indicative letter of offer, or you can also mandate your client directly. Either one, we like to include it in the offer so that everyone knows exactly who's getting paid what up front, and because we're all about that transparent loan process. The other thing that we do that I don't know of any other lender that does this in the marketplace is that we pay subsequent referral fees even if the client comes direct. So if you refer John Smith to us, then we see John Smith as your client, and if John Smith borrows some money from us, he then has a great experience. He then comes back and borrows some more money down the track, but he comes to us directly. We will still pay you your share of the approval fee. Okay, so which is actually a bit of fun for us. If we have a client that comes back and that we can do all the work on the deal, and to call up one of our referrers and say, hey, look, John Smith came back. Can you send your invoice in for $3,000 or $5,000 or whatever it might be? It's always a nice surprise for our referrer that they're going to get paid, even though they didn't have to work on the file. So it's just another way that we say thank you to our referrers for recommending one of your clients to us. And finally, we also have a referrer rewards program, which is a bit of a mouthful, but it's just as you hit different key milestones of loan volume that you'll get gift cards. So this, you do a $500,000 loan, you'd get a $250 gift card of your choice. So it could be Dan Murphy's, could be Flight Centre, could be Myers, whatever you want. We'll send it through to you. Also, it's worth mentioning that they are cumulative as well. So if your first loan that you settled with Private Mortgages Australia was a $3 million loan, you would get the $2,500 gift card plus the $1,000 plus the $500 plus the $250 as well. So it definitely starts to add up very quickly. And you would also get into what we've called PMA's Platinum Playground, which basically means that you're a lifetime member and that you receive a $500 gift card every year, provided you hit that minimum loan balance of $5,000. So just another way that we reward our referrers. Now, just to finish up here, because I do want to keep the webinar short, sharp, and shiny, is just go through what we sort of specialize in. We've sort of covered that we do a lot of development funding, and look, we're definitely seeing a huge demand for that at the moment. And we've spoken about urgent funding as well, people that just can't wait for the banks to, do the loan. We see a lot of people that look at asset lending as well, where they can't show serviceability. Serviceability is a massive, massive issue in the banking world at the moment. Just speaking to mortgage brokers recently, it's becoming increasingly hard to get loan applications through, and the serviceability is a big one. Now, because we do short-term lending and our loans are prepaid, so if the client wants a loan for 6 months, we actually prepay the loan for them for 6 months. Because there's no actually payments to be made, for us, we don't really look at serviceability. because there's no payments to be made. We're more focused on what's the exit strategy. How are they going to repay the loan at the end of the 6 month? Whether it be, the sale of a property, or they might be getting refinanced, or they might be in a position where they've then got maybe plans and permits, or whatever the case may be. We're more focused on how their repayment strategy opposed to their serviceability. So that can be a huge value for some of your clients that just are having issues with the bank around that serviceability. Another big one is ATO debts. So a lot of banks don't like lending against someone who has an outstanding ATO debt or an ATO portal. So they can get a short-term loan from us to clean that ATO debt up, and then it's a lot easier for them to go and get refinanced through a mainstream institution. We've also done refinancing of caveat loans. So especially defaulting caveat loans, we've seen some pretty high interest rates, sort of your 15 to 20% per month sort of stuff we've seen of caveat loans that have just gone into default, where we can come in, cash them out, and get it down to a much more reasonable interest rate to give that client a little bit more breathing space. Something else we do is valuation, not contract price. So we will actually lend on the higher of valuation or contract price, because ultimately we're property investors at the core of it, and we live in the real world where you can add value to a property after you've bought it, or add value before you have to settle on it, or you might have bought the property under market as well. So we've done a deal before where we actually lent over 100% of the purchase price, because that for us, when we got a valuation, it was only 70% of the value of the property when we got it valued. So something else we can be, I suppose, be more flexible on than a bank. Last one I want to mention is the one at the bottom there, is credit impaired. So just like the serviceability, credit is not an issue for us. We're more focused on the asset itself. The only time where credit might be an issue for us is if the client's exit strategy to repay the loan is to refinance. Well, then great, let's have a look. We want to make sure they've got good credit so they can actually get refinanced. Okay, we don't want to set the client up for failure. We want to make sure that they've got a good chance of doing that exit strategy and refinancing. So that's where it might come into a play, but it's not so much of an issue for us. So just second last slide here, just to talk a little bit about the PMA way. And our tagline at Private Mortgages Australia is cleaner loans, better results. Okay, so it's all about transparency and a win-win outcome for both parties. The way we do that is we have those low upfront assessment fees, so $550 to $770. We've seen some people out there charging tens of thousands of dollars as an assessment fee, and if the deal doesn't stack up, then the client's lost that and see you later. And that's just not what we're about. We're about making money by lending it, not by just getting offers in and not doing any transactions. The other big one we do is we have no charging clauses or cancellation fees in our indicative letter of offer. So if the client signs the indicative letter of offer and then changes their mind or doesn't want to proceed for whatever reason, there's nothing else they need to pay other than that small assessment fee. The valuations are always done at cost, so it's done on a flow-through basis. But the other big one is that we do the valuation for a reasonable value. So we'll typically ask for the valuer to give us market value, or for mortgagee purposes, we don't ask for forced sale valuations. Okay, so some other lenders will get a forced sale valuation, which is basically asking the valuer to, put down 10 or 20% less than what it's actually worth on the valuation, and is not a true representation of market value. So that's a big thing to look out for with other lenders. Just make sure that it's going to be done for a reasonable value. Legal fees are always done at cost as well. We always rebate unused interest on extension payments. So a lot of our loans will come with an extension arrangement. So it might be, you might get 3 months worth of extensions, and if the client, let's say they pay an extension payment, then 1 week later they settle, we'll rebate the extra 3 weeks of the month that they didn't use. Okay, the only thing that we won't rebate is the prepaid loan term. So if the client has a prepaid loan for 3 months, then if they pay it out at the end of 3 months or after 1 day, there's no funds that get rebated, because the loan is priced based on that there's going to be a minimum interest period of, let's say 3 months. The other thing we've got is custom built software, and that's really at the backbone of our faster processing times, that we've got software that's enabling us to very, very quickly analyze and process transactions. And this really leads us, all these things lead us to a high level of repeat customers. That's how we know we're doing a good job, when we have people coming back to us time and time again because they've had a good experience with us. And that comes from our win-win approach to lending, and that's what we're all about. Is if we can do those cleaner loans, we find we get that better result for us and also for the client. So guys, if you do have any questions, or you've got a particular loan scenario that you want to run past us, please contact our Senior Relationship Manager, Shanta Lobo, directly. You can either email her, or there's her direct contact number there. The other thing is worth checking out is our website, privatemortgagesaustralia.com.au. We have a resources section. There's heaps of little videos in there on different aspects of private lending, and lots of different tools and stuff that you can use in there as well. So if we don't speak with you, please have a great Christmas break, and we look forward to seeing you guys in the new year. We will be working straight through, so we will be taking the main public holidays off. Otherwise, we'll still be around for any sort of urgent loans that you or your clients have. Otherwise, we'll see you in 2019. Thanks, guys.